Usually when we think about the ultimate shortcut to understanding the future of global markets, there's this expectation that we just have to look toward Silicon Valley.
Right. Yeah. It's almost a reflex at this point.
Exactly. You picture the sprawling glass campuses, the endless venture capital, disruptive tech startups in garages.
Oh, absolutely.
And the assumption is just, well, there it is. That's tomorrow.
Mm.
That's where the future is being built.
Yeah, we like to look at those established tech hubs because they're visible, right? They're neatly categorized. And frankly, they just fit our traditional narrative of where and how innovation is supposed to happen.
Right.
It's safe. It's very predictable.
But then you step into the world of emerging markets, specifically the African continent, and suddenly that Silicon Valley lens is entirely shattered.
Oh, completely. It's a totally different ballgame.
It really is. We're looking at a commercial landscape that is completely different. I mean, the constraints are different, the demographics are different, the infrastructure hurdles are just massive. So what if the ultimate shortcut to understanding the future of emerging markets, the real frontier of high-stakes, do-or-die innovation, wasn't found in California at all?
Okay, I like where you're going with this.
What if it was actually on the Johannesburg Stock Exchange?
It's a fantastic premise because when you look at the African market, you're looking at the absolute definition of a dynamic, untested, and frankly, incredibly high-stakes economic environment.
Yeah.
You don't innovate here just to, boost a quarterly profit margin by a fraction of a percent.
Not about minor tweaks.
Exactly. You innovate for raw survival. The environment forces a completely different kind of evolution. If your technology or your business model isn't practically bulletproof and deeply integrated into the daily reality of the consumer, you just disappear.
Exactly. And that is our mission for today. Welcome to the Deep Dive.
Glad to be here.
We are unpacking an incredible amount of research focusing on 6 absolute heavyweights of the JSE. So we're talking Discovery, Old Mutual, Standard Bank, Tiger Brands, Woolworths, and MTN Group.
That is a serious lineup.
It really is. We are going to uncover how these legacy giants, and I mean some of them date back literally to the 1800s, how they are aggressively, almost ruthlessly, reinventing themselves to capture the immense growth of the African market.
And what I find so compelling about this is that we aren't just looking at dry financial reviews or, static balance sheets today.
No.
We are exploring deep structural stories of technological disruption. These are management teams navigating currency crises, shifting demographics, entirely new digital frontiers all at once.
And for you listening, we really need to be clear right up front. These specific companies we're diving into aren't just, theoretical case studies we pulled out of thin air to talk about innovation.
Right.
They're actively part of the iMaps capital markets universe.
Which is huge.
It is. What that means for you practically is that they are investable right now via interactive brokers. And they're eligible for iMaps actively managed certificates on the EU AVIX in Stuttgart.
Yeah, so this isn't just an academic exercise we're running through today.
Exactly. This is highly actionable, highly relevant intelligence on some of the most critical equities on the entire African continent.
It brings a very practical lens to our conversation. Because to truly understand the African consumer and this massive growth story, you can't just jump straight into what they're buying at the grocery store.
Right.
You first have to look at the foundational infrastructure that actually connects them. I mean, you simply cannot have modern banking or digital retail or personalized healthcare without the digital plumbing already being deeply entrenched.
Okay, well, let's unpack that plumbing then, because it starts with MTN Group.
It definitely does.
Now, historically, most people, even seasoned investors, I think might think of MTN as just a traditional telecom company, selling physical SIM cards, charging for voice minutes, sending text messages.
Yeah, that's the classic view.
But when you dig into their current strategy, that is a wildly outdated view. MTN is morphing into an emerging tech giant. I mean, they have over 307 million subscribers across their markets.
It's a staggering number.
To put that sheer scale into perspective, that is almost the entire population of the United States, all plugged into one single unified network. It's almost like they are trying to become nothing less than the primary operating system for the African continent.
That operating system analogy is actually the perfect way to frame it. The strategic transition they are executing is moving from being a traditional telecommunications provider to a tech co.
Right, a technology company.
Exactly. They have this massive strategic framework they call Ambition 2030, and it explicitly outlines this shift.
Mm-hmm.
The days of a telecom company making its margins purely off charging you for a 10-minute phone call to your grandmother, well, those are completely over.
Yeah.
The new monetization engine, the absolute lifeblood of their revenue, is data.
And the volume of that data is what blew my mind when I was reading the reports. We are seeing average monthly data usage across their network hitting 12.5 gigabytes per user.
Oh, yeah.
That isn't just a gradual uptick. That is a staggering acceleration.
It really is, and it's driven fundamentally by a massive continent-wide migration from older 3G networks to 4G, and now aggressively into 5G.
Right.
Take a massive market like Nigeria, for instance. MTN hasn't just been resting on its laurels there. They've already deployed over 2,500 5G sites.
Wow.
Yeah. And when you upgrade a user from a slow connection to high-speed broadband, their consumption habits change overnight.
Of course they do.
They go from sending text-based WhatsApp messages to streaming high-definition video, running businesses online, utilizing cloud services. That drives data revenue through the roof.
But the data is really just the highway, right? The cars driving on that highway are what I find truly fascinating.
Yeah.
Let's talk about the Momo juggernaut-MTN mobile money.
Oh, this is the really exciting part.
The numbers here are almost difficult to comprehend if you're used to Western banking systems.
Yeah.
We are talking about 70 million monthly active users.
Incredible.
And the projected transaction volume for 2025? Over $500 billion US.
$500 billion.
Exactly. Flowing through a mobile application.
Which raises the fundamental question. Why is Momo so wildly successful? Why didn't a traditional bank build this?
Yeah, why didn't they?
Well, the answer is that Momo is not just an app on your phone. It has become a closed-loop economic ecosystem.
Okay, unpack that a bit.
So in many of these operating markets, a huge percentage of the population is completely unbanked. They don't have checking accounts, they don't have credit scores, they don't have access to formal financial institutions.
Right.
Momo stepped into that void and essentially said, your phone number is now your bank account. They provided peer-to-peer transfers, microloans, insurance products, everyday merchant payments.
Right, but you can't just snap your fingers and mandate a cashless society overnight.
Oh, definitely not.
Especially in economies that are deeply, deeply rooted in physical cash.
Yeah.
You need a bridge. And that's the genius of what they built, right?
Yeah.
An absolutely unreplicable network of physical agents.
This is the key.
We're talking hundreds of thousands of local agents.
Yeah.
Often just a person sitting at a small kiosk or a local corner store where everyday people can walk up, hand over physical paper cash, and have it instantly converted into digital Momo currency on their phone or vice versa.
That human infrastructure is the ultimate competitive advantage. A new tech startup out of London. But they cannot organically replicate a trusted network of 400,000 local agents across rural and urban Africa. That physical presence creates an incredibly deep economic moat.
Think about the stickiness of that. If you're a merchant in Ghana or Nigeria, and all your customers pay you via Momo, your suppliers expect to be paid via Momo.
Yep.
And your ability to get a microloan to buy tomorrow's inventory is based on your Momo transaction history. I mean, the switching costs to leave that platform and try a competitor are impossibly high.
Absolutely.
You are locked in, but in a way that actually enables your economic life.
Precisely. It's a benevolent lock-in from the user's perspective, but a highly defensive moat from MTN's perspective.
Right.
And MTN management knows that to protect this incredibly valuable digital operating system, they have to absolutely control the physical hardware layer beneath it.
Okay, yeah.
Which brings us to the fascinating and frankly counterintuitive infrastructure play they're making.
Yes, here is where it gets really interesting and honestly a bit confusing at first glance. Under this Ambition 2030 plan, they are executing what they call a network as a service strategy.
Right.
They want to own the massive underwater and terrestrial fiber networks, their Belbab network. They want to own the data centers. And crucially, they want to own the physical cell towers. In fact, they recently executed a massive $6.2 billion acquisition of IHS towers. Now, wait a minute. Didn't global telecom companies spend the entire last decade doing the exact opposite?
They absolutely did.
I thought the prevailing wisdom was to spin off physical cell towers, sell them to specialized infrastructure companies, and become asset-light to please shareholders. Why is MTN spending $6.2 billion in hard cash to buy back the very physical towers they previously sold off?
It looks like a strategic reversal, and, well, it is, but it's a highly calculated one driven by the specific realities of the African market.
Okay.
The asset-light model works brilliantly in Europe or North America, where electricity is stable and inflation is relatively predictable.
Right, that makes sense.
But by internalizing those towers, we're talking over 37,000 physical towers across Africa, MTN is capturing the profit margins they were previously paying out to IHS in leasing agreements.
Ah, so instead of paying a landlord, they're buying the building.
Exactly. And in an environment plagued by volatile energy costs and extreme currency fluctuations, owning the underlying physical asset gives you cost predictability.
Interesting.
Think about a cell tower in a remote area. It often isn't connected to a reliable national power grid. It runs on diesel generators.
Oh, wow.
Yeah. When the price of diesel spikes or the local currency devalues, making imported fuel wildly expensive, tower operators pass those costs on to the telecom companies. By owning the tower, MTN controls its own destiny regarding energy efficiency upgrades, like installing solar panels.
Oh, that's smart.
Plus, they aren't just paying themselves rent. They can lease out excess capacity on those 37,000 towers to their competitors, turning a cost center into a revenue generator.
I have to push back on that logic, though, because I'm looking at the sky right now, and I'm seeing low Earth orbit satellites.
Ah, the Starlink question.
Exactly. Starlink is expanding rapidly across the African continent. If Elon Musk can beam high-speed broadband directly from a satellite in space to a smartphone or a rural village, completely bypassing the ground infrastructure, isn't buying 37,000 physical steel towers for $6.2 billion a massive existential risk? Aren't they basically buying what could very soon become stranded, obsolete assets?
It is a highly valid challenge, and it's a debate happening in boardrooms globally right now.
Right.
Satellites can entirely bypass terrestrial networks, and they are particularly devastating to the economics of rural coverage. Building and maintaining a physical tower in a deeply rural area with very few users is incredibly expensive. If Starlink can cover that area from space for a fraction of the cost, the terminal value of those specific rural towers drops significantly.
So they're throwing billions at obsolete tech.
Well, not entirely. The caveat is data density.
Okay.
Low Earth orbit satellites are fantastic for broad, dispersed coverage, but they currently struggle with immense concentrated data density.
I see.
If you look at massive urban center cities like Lagos with over 20 million people or Johannesburg, the sheer volume of data being consumed simultaneously in a 1 square mile radius is staggering.
Oh, yeah, that makes sense.
Satellites simply don't have the capacity to handle that level of dense urban throughput yet. For that, you still heavily rely on terrestrial fiber optics and extreme tower densities. So MTN is betting that the core of their revenue, which is urban data consumption, will require physical towers for the foreseeable future.
That makes sense. It's a barbell risk. Rural towers might be stranded, but urban towers remain cash cows. But that isn't the only risk they are juggling. When you dig into the footnotes of these companies, you find some wild black swan threats.
Oh, definitely.
For instance, MTN is currently facing a €4 billion, that is over 4.3 billion US dollars trademark lawsuit.
Yeah, that's a big one.
And it's from an Irish football club called AC Shining Stars, claiming MTN infringed on their trademark over the use of the name mobile money across 14 different countries.
It sounds absurd on the surface, right? An Irish football club suing an African telecom giant.
It really does.
But the sheer scale of the damages claimed makes it a material threat. And that's coupled with a formal whistleblower complaint to the U.S. Securities and Exchange Commission, alleging that MTN management didn't properly disclose this massive contingent liability to their investors.
Wow.
Now, a contingent liability is essentially a potential future cost that depends on the outcome of a specific event, like a lawsuit.
Man.
While the CEO projects absolute confidence that they will win, you cannot ignore the math. A €4 billion claim equates to roughly 70% of the entire value of that massive IHS tower deal we just discussed. It is a massive dark cloud hanging over their valuation.
Not to mention the macroeconomic environment they operate in. Let's talk about the Nigerian Naira.
Right.
MTN Nigeria is undeniably their absolute growth engine, the crown jewel of the portfolio. But in 2024, the Naira virtually collapsed against the US dollar.
It was brutal.
It is a brutal lesson in emerging market realities. I mean, you can have the absolute best technology, the highest market share, phenomenal user growth, and still get your reported global earnings absolutely decimated purely by currency devaluation.
Which perfectly illustrates the mechanical problem of operating in Africa. MTN collects billions of naira from its customers in Nigeria.
Hmm.
But when it needs to buy a new 5G server from Ericsson or pay a dividend to international investors, it has to convert those naira into US dollars.
Right.
When the naira loses half its value overnight, MTN's actual purchasing power and reported profits vanish, even though their underlying business in Nigeria is booming.
Which is exactly why their pivot to becoming a Pan-African techco is not just a nice marketing slogan, it's a desperate urgency.
Absolutely.
They have to outgrow those localized currency risks by creating irreplaceable digital value that transcends borders.
Exactly.
So if MTN is building the digital plumbing and the mobile wallet to facilitate all this connection, what happens when you combine that raw connectivity with incredibly complex, data-driven financial products?
This is where it gets fun.
Because moving money is just step one. What happens when you start analyzing how that money is spent to actually change human behavior? That brings us to Discovery and Old Mutual, two titans of South African finance, but they're approaching the modern consumer from entirely different, almost opposite angles.
It is one of the most fascinating corporate contrasts you can study. You have one company trying to invent the future of behavioral economics and another trying to frantically defend a 180-year-old legacy from digital upstarts.
Let's start with the disruptor, Discovery Ltd. I absolutely love looking at this business model because they looked at insurance, which is historically this incredibly static, adversarial, zero-sum game.
Right.
Traditionally, you buy life or health insurance, and you only win financially if something terrible happens to you.
Which is a terrible incentive structure.
It is. And the insurance company only wins if you stay perfectly healthy and keep paying premiums until you die. It's a fundamentally misaligned relationship. Discovery completely flipped that dynamic.
They really did.
They invented what they called a shared value model. When you look at how it actually functions, it's like having a personal trainer, a financial advisor, and a life coach all embedded inside your wallet.
The architecture of what Discovery built is brilliant because it addresses human psychology, not just actuarial math. Through their core program, which is called Vitality, they actively, intentionally intervene in their members' lifestyle choices. They don't just calculate your risk and send you a bill, they actively work to lower your risk.
Right. They gamify your health.
Yes.
They reward you with heavily discounted gym memberships at places like Virgin Active. They give you massive cash back for buying healthy food at Woolworths. They even give you discounted international flights.
It's crazy.
And you earn all this simply by logging your workouts, eating right, and going for regular checkups.
So the consumer feels like they are winning because they get healthier and unlock all these tangible, high-value perks. But Discovery gets the real prize.
Which is?
Well, the underlying mechanics of insurance dictate that a healthier policyholder goes to the hospital less often, files fewer claims, and lives longer, paying premiums for decades.
It's a massive win-win.
Exactly. It creates what actuaries call behavioral alpha. Alpha usually refers to an investment return that beats the market. Here, it refers to an insurance margin that beats the industry average purely because the clients are behaving better than the general population.
That's amazing.
But, and this is the critical technological hurdle, to actually execute this model, you need data. Unfathomable amounts of data. And over the past couple of decades, Discovery has quietly built arguably the deepest, most comprehensive actuarial data moat in the world. We're talking roughly 60 million life years of behavioral health data.
Let's pause on that because it's a huge point. A traditional insurance company uses incredibly static, frankly outdated demographic tables to price your policy.
Right.
They look at your age, your gender, whether you check the box that says you smoke, and maybe your zip code. That's it. They set your price and forget it.
Very basic.
But Discovery, on the other hand, is tracking your daily steps via your Apple Watch.
Yeah.
They are monitoring your sleep patterns. They literally know the exact nutritional breakdown of your grocery basket in real time because their systems are integrated with the supermarket checkout.
And now they're pouring high-octane gasoline on that data fire.
Oh, wow.
Yeah. When you look at their recent strategic moves, there is a massive global partnership with the Google Cloud to launch something called Vitality AI.
Okay, AI is everywhere now.
It is, but here it actually makes sense. They are taking Google's most advanced artificial intelligence, specifically the Vertex AI platform and their Gemini large language models, and they are unleashing it onto those 60 million life years of historical behavioral data.
So mechanically, what does that actually look like for the user?
It moves the system from generic advice to hyper-personalized contextual intervention.
Give me an example.
Instead of the app just sending you a generic push notification at 5 p.m. on a Tuesday saying, don't forget to go for a run today, the AI understands your specific context. It knows you slept poorly last night, it knows you bought high-sugar snacks 2 days ago, and it knows your calendar is clear for the next hour.
That is slightly terrifying.
It is. But it might send a highly tailored nudge saying, based on your sleep data, a 20-minute walk right now will optimize your recovery and will boost your vitality points by 15% if you do it in the next hour. It is precision-guided behavioral modification at scale.
That is wild. It's almost slightly dystopian, but if it keeps you out of the hospital, the value proposition is undeniable.
Absolutely.
And what's fascinating is how they are monetizing this. Discovery is no longer just a South African insurance provider. They are essentially a global B2B technology platform.
Right.
Through what they call their Vitality Global Licensing model, they act in a B2B2C capacity, business to consumer. They take this entire AI-driven behavior engine, this massive psychological algorithm, and they license it to other massive insurance companies all over the world.
Yes. Companies like John Hancock in the United States or Ping An in China, which is one of the largest financial institutions on Earth. Those companies don't have the decades of behavioral data to build this themselves, so they rent Discovery's brain. And for Discovery, this is the holy grail of revenue. They earn incredibly high-margin licensing fees, paid in hard currencies like US dollars or euros, with virtually zero capital intensity. They don't have to build offices in New York or Shanghai. They just deploy the software.
And domestically, back in South Africa, they've taken this exact same behavioral modification model and applied it to banking.
Right. Discovery Bank.
Yeah. If Vitality makes you physically healthy, Discovery Bank uses a program called Vitality Money to make you financially healthy. They reward you with better interest rates on your savings or lower rates on your loans based on how responsibly you manage your credit and your spending.
Which is a beautiful concept, but building a bank from scratch is brutally expensive. For years, Discovery was burning through billions of rands in startup costs, building the core banking systems, acquiring the licenses, marketing the product.
Yeah, it's not cheap.
The financial markets famously referred to this period as the valley of death for their balance sheet.
But they just made it out. The latest numbers show Discovery Bank has finally crossed the threshold into operating profitability.
That's a huge milestone.
They hit 1.4 million clients, and their mortgage lending, which is highly profitable, sticky product, is surging by over 200%.
Getting the bank to profitability is a monumental catalyst for the stock because it removes that massive startup discount that analysts were penalizing them with. However, as brilliant as Discovery is, we cannot ignore the primary external threat hovering over their domestic business.
Right.
And this is highly political, though we are going to look at it purely through a factual mechanical lens. South Africa's National Health Insurance, or NHI Act.
Right. The NHI is arguably the most hotly debated piece of legislation in the country. Now, the stated goal of the NHI Act is to centralize all health funding in South Africa into a single state-run fund to provide universal coverage.
Yeah.
How does that mechanically impact a private giant like Discovery?
The private healthcare administration market is the absolute bedrock of Discovery's domestic business. It is their most stable, reliable cash generator. They hold roughly 57% of the entire open medical scheme market in South Africa.
Wow.
The current wording of the NHI legislation suggests that once the state fund is fully implemented, private medical schemes will not be allowed to provide cover for services that are already covered by the NHI.
Okay.
If that is strictly enforced, it essentially outlaws their core domestic product, fundamentally threatening that foundational revenue stream.
Now, practically speaking, implementing a universal healthcare system of that scale in a developing economy is a massive logistical and financial hurdle. Full implementation is likely a decade or more away, and it's currently facing a mountain of constitutional and legal challenges.
That's true, but the stock market is a forward-looking discounting mechanism. Even if the execution is 10 years away, the market prices in that long-term regulatory obsolescence risk today. It acts as a ceiling on their valuation.
Which perfectly explains why they're pushing so aggressively into global AI licensing and domestic banking. They aren't just expanding, they are building lifeboats. They are diversifying their revenue so completely that if the domestic health insurance market evaporates, the company survives.
Exactly.
Now, let's pivot to the other side of the financial spectrum.
Yeah.
If Discovery is the high-tech, AI-driven disruptor, Old Mutual is the grandfather, the 180-year-old legacy institution.
Yep.
To put it in perspective, Old Mutual was founded in 1845 in Cape Town. They started with 166 policyholders and literally zero seed capital. Fast forward to today, and they are a Pan-African behemoth, employing tens of thousands of people and throwing off a massive 7.5% dividend yield to their investors.
Old Mutual's economic moat is not built on cutting-edge algorithms. It is built on deep heritage, generational trust, and sheer physical scale. They have 346 dedicated branches and over 580 physical locations in South Africa alone. And this is crucial. In what they call the mass and foundation market, essentially the lower to middle income segment, that physical bricks and mortar presence is absolutely vital.
Right, because if you are a blue-collar worker, setting aside a small fraction of your paycheck every month for a funeral policy or life savings, you don't want to talk to a chatbot.
Definitely not.
You want to walk into a building with a brass plaque, look an advisor in the eye, and know your money is safe.
Exactly. The psychology of trust in the mass market is heavily tied to physical permanence. But this is where the narrative takes a sharp turn, because despite having this 180-year-old highly profitable life insurance business that practically mints cash, Old Mutual just did something that shocked the market.
Yes, and this is the part I was really scratching my head over when reading the financials. They just announced a 3 billion rand impairment to build a brand new transactional digital bank called OM Bank, completely from scratch.
It's a massive move.
Let's define impairment real quick for our listeners. It essentially means they spent a massive amount of money building this asset and then had to admit on their balance sheet that it's currently worth significantly less than what they paid to build it. They wrote down the value by 3 billion rands. Why on earth would a legacy life insurer take on that kind of colossal capital risk to enter the brutally competitive banking sector?
It seems insanely risky, but when you look at the underlying mechanics of consumer behavior, it is a strict defensive necessity. Old Mutual is a fortress, but that fortress is under siege in its core mass market segment.
Okay.
For decades, they owned the funeral cover and basic life insurance market. But over the last few years, aggressive digital-first neobanks, specifically a juggernaut named Capitec, have completely rewritten the rules of engagement.
How so?
It comes down to the frequency of interaction. Think about your own life. How often do you interact with your life insurance company?
Maybe once a year when they send you an annual statement, or God forbid, when someone passes away.
Right. It is an incredibly low-frequency, low-touch relationship. Now, how often do you open your banking app?
Oh, probably 3 or 4 times a day.
Yeah.
Checking a balance, transferring money, paying for a coffee.
Exactly. Capitec realized that because they own the daily transactional relationship, the high-frequency app opens, they have the ultimate digital real estate. They have the consumer's attention.
Ah, I see.
So Capitec started cross-selling simple insurance products directly inside their banking app, and it has been devastatingly effective. Capitec has seen its insurance income surge by 45% recently, and a huge chunk of that growth is eating directly into Old Mutual's historical market share.
Wow. So because the bank is in your pocket every single day, it effortlessly outcompetes the 180-year-old brand that only talks to you once a year.
Precisely. Old Mutual management looked at this and had a terrifying realization. You cannot survive the next decade as a low-frequency interaction partner.
That makes sense.
If you don't own the daily transactional data of your customer, you become invisible. You lose the ability to cross-sell, and more importantly, you lose the granular data you need to price risk accurately. If Capitec knows exactly how a customer spends their money every day, Capitec can offer them a better, cheaper insurance premium than Old Mutual can.
Hence the desperate need for OM Bank.
Yeah.
Old Mutual has roughly 7 million existing clients in that mass market segment. If they can convince even a fraction of those existing life insurance clients to open an Old Mutual checking account, they suddenly enclose the ecosystem.
Yeah.
They get the daily data, they protect their insurance base, and they block Capitec out.
That is the strategic theory. But execution is brutal. That R3 billion impairment we mentioned shows that building a core banking system, the incredibly complex back-end software that processes millions of transactions securely in real time, is much harder and vastly more expensive than they modeled.
Right.
They admitted to the market that the capital requirements are higher and the return on that investment is going to be lower and slower than originally expected.
Though, to be fair to them, the early adoption metrics show some promise. They are currently in a soft launch phase, testing the systems before a massive marketing push, and they are already signing up 5,000 customers a day. If they can maintain that velocity, OM Bank becomes a serious player very quickly.
And banking isn't the only front they are fighting on. They are actively trying to modernize their asset management division as well. They recently spent 2.2 billion rand to acquire a company called 10x Investments.
Let's break that down because the shift in how people invest is a massive theme globally.
Right. Historically, Old Mutual made a fortune selling active investment funds. You pay a high fee to a portfolio manager in a suit who tries to pick winning stocks.
Right.
But globally, and now aggressively in South Africa, consumer preference has shifted massively toward passive investing, things like low-cost exchange-traded funds or ETFs that just track a whole index like the S&P 500 or the JSE Top 40 for a fraction of the fee.
Because study after study shows that over a 10-year period, very few active managers actually beat the simple low-cost index fund.
Exactly, and Old Mutual was losing ground to rivals like Sanlam, who own a massive passive ETF business called Satrix. So Old Mutual bought 10x Investments, which is a technology-led, low-cost passive index provider, to plug that hole in their defense.
Okay.
When you step back and look at OM Bank and the 10x acquisition together, you see a 180-year-old ocean liner desperately trying to refit itself into an agile, integrated, modern financial services fleet before it gets sunk by the digital disruptor.
That is a phenomenal story of adaptation. So Discovery is using AI to literally change how human beings behave. And Old Mutual is spending billions to build a bank just to defend its historical turf.
It's incredible to watch.
But let's zoom out. Someone has to actually finance all this macro movement. Someone has to move the capital that builds MTN cell towers, funds Discovery's AI data centers, and facilitates the massive flow of physical trade across the entire continent. And that brings us to Standard Bank.
Standard Bank is the undisputed macroeconomic titan of this conversation. While Discovery and Old Mutual are locked in a vicious street fight for the individual retail consumer's wallet, Standard Bank operates on a sovereign continental scale.
You aren't kidding about the scale.
Yeah.
We're talking about a bank operating in 20 different sub-Saharan African countries. They just posted record headline earnings of 49.2 billion rand.
Massive.
And their history is incredible. They literally started in a canvas tent in 1886 during the Witwatersrand gold rush, weighing gold dust for miners.
Oh, wow. I didn't know that.
Yeah. Today, they are the primary financial gateway to the African continent. But when you dig into the mechanics of their profitability today, their ultimate economic moat isn't actually African, it's Chinese.
Yes. This is the structural advantage that sets them apart from every other bank on the continent. In 2008, Standard Bank entered into a massive strategic partnership with the Industrial and Commercial Bank of China, ICBC, which is by many metrics the largest bank in the world. ICBC acquired a 20% equity stake in Standard Bank. But this wasn't just a passive investment where they park their money and wait for a dividend.
It was a pipeline.
Exactly. It created an exclusive financial pipeline. It gives Standard Bank privileged, almost monopolistic access to the world's largest and most active trade corridor, the China-Africa axis.
What does that actually look like in practice?
Think about the physical reality of the global economy. When a Chinese state-owned enterprise builds a multi-billion-dollar hydroelectric dam in Kenya, or when millions of tons of copper are exported from the Democratic Republic of Congo to battery factories in Shenzhen,
Right.
or when thousands of shipping containers filled with cheap electronics flow into the port of Durban, all of that massive, complex, cross-border financial activity requires letters of credit, currency hedging, and massive syndicated loans.
And Standard Bank is right there.
Exactly. Standard Bank acts as the primary toll booth for that entire corridor. They capture roughly 15% of all related banking revenue generated on that China-Africa axis.
That is an impenetrable moat. No local competitor can just decide tomorrow to take 15% of Chinese sovereign trade flow. And they are modernizing that toll booth incredibly aggressively.
They really are.
The internal IT transformation happening at Standard Bank right now is staggering. The research highlights that 71% of their massive server workloads have already been successfully migrated off old, legacy on-premise mainframes and onto cutting-edge public cloud platforms like AWS and Microsoft Azure.
For a deeply entrenched legacy bank of that sheer size, operating across 20 different regulatory jurisdictions, executing a cloud migration of that scale is akin to performing open-heart surgery while running a marathon.
Seriously.
Legacy banking IT systems are notoriously fragile and siloed. By moving to the cloud, they break those silos down. It allows them to deploy new digital products in weeks instead of years, and more importantly, it allows their risk management teams to process vast amounts of cross-border data in real time.
Wow.
Managing their exposure to volatile African markets with hyper-precision.
And the broader stock market has clearly recognized this execution. Standard Bank stock rallied an incredible 48.4% over the last 12 months. But we have to be intellectually honest here and attribute a large portion of that massive rally not just to their internal cloud strategy, but to massive macroeconomic tailwinds that lifted the entire South African banking sector.
Undoubtedly. Standard Bank is heavily leveraged to the overall health of the South African sovereign state. And two massive positive macro events occurred recently.
Right.
First, the formation of South Africa's Government of National Unity, the GNU. After a highly contested election, the formation of a centrist coalition government dramatically stabilized the perceived political and sovereign risk of the country. International bond yields dropped, the currency stabilized, and that immediately re-rated the banking sector.
And the second highly technical but massive event. South Africa was officially removed from the FATF gray list.
Yeah.
Let's explain the mechanics of that, because it sounds like obscure bureaucratic jargon, but it dictates billions of dollars in global capital flows.
FATF is the Financial Action Task Force. They are the global watchdog for money laundering and terrorist financing. A few years ago, South Africa was placed on their gray list due to deficiencies in their regulatory oversight.
Okay.
For a massive institution like Standard Bank, being domiciled in a gray-listed country is a nightmare. It essentially ties the hands of international institutional investors. European and American pension funds often have strict mandates that legally prohibit them from investing in gray-listed jurisdictions.
So it artificially starves the country of capital.
Exactly. And for the banks themselves, it means international correspondent banks subject every single cross-border transaction to enhanced due diligence, the compliance costs skyrocket, and the speed of business grinds to a halt.
Right.
Coming off that list recently was like unkinking a massive financial hose. Compliance costs plummet, and international institutional capital is legally allowed to flood back into the South African banking sector. Standard Bank, as the largest player, absorbed a massive wave of that returning capital.
Okay, so let's tally this up. They have a pristine Tier 1 capital ratio of 15.1%, which basically means their balance sheet is fortified like a bunker. They have modernized their IT stack onto the cloud. They dominate the China-Africa trade corridor with ICBC.
Yeah.
And the macro environment just cleared up massively.
Yep.
With all that going perfectly right, what could possibly slow them down?
It's the right question to ask, especially after a 48% rally. The research outlines a very specific and highly realistic bear case. It centers on what analysts call geopolitical credit shocks. Standard Bank is inherently highly sensitive to global commodity prices, specifically oil. Because
almost everything in Africa moves by diesel truck.
Precisely. If geopolitical conflicts, say, an escalation in the Middle East spikes the price of Brent crude oil back over $100 or $110 a barrel, it creates an immediate stagflationary shock across the African continent.
Oh, wow.
The cost of transport doubles, food inflation skyrockets, and economic growth stalls. Central banks across the continent are forced to keep interest rates punishingly high to fight the inflation.
Right.
And suddenly, the millions of everyday consumers and small businesses holding loans from Standard Bank simply cannot afford their monthly repayments. They start to default en masse.
Right. And currently, their credit loss ratio, which is the percentage of their total loans that they expect to go bad and never be repaid, is incredibly healthy at just 73 basis points. That's 0.73%.
Very low.
But in a stagflationary shock,
yeah,
that ratio would spike dramatically, wiping out their profits.
Exactly. Add to that the constant grinding threat of currency volatility. Roughly 40% of Standard Bank's earnings come from their operations in the rest of Africa, outside of South Africa. In 2024 alone, the severe devaluation of the Nigerian naira and the Angolan kwanza literally wiped 9% off their total RAND reported headline earnings.
That's a huge hit.
It is. They are hostage to the monetary policy and central bank competence of 20 different developing nations.
And there's a significant internal transition looming as well. The reports note that their highly respected, long-standing CEO, Sim Shabala, who is largely credited with architecting and executing this successful Pan-African strategy, is slated to reach mandatory retirement age in 2027.
Right.
Replacing a visionary leader introduces immense execution risk,
right,
precisely as the bank is trying to hit its aggressive 2028 return on equity targets.
Which perfectly encapsulates the valuation dilemma and why iMaps Capital Markets currently rates Standard Bank as a neutral rather than a buy. It is undeniably a high-quality, brilliantly run asset, but it is currently trading at a forward price-to-book ratio of 1.5 times.
Let's translate that metric. Price to book essentially measures what the stock market is willing to pay for the literal net assets on the bank's balance sheet.
Correct. And a multiple of 1.5x means the market is paying a 50% premium over the actual liquidation value of the bank. That multiple is currently 17% higher than Standard Bank's own 10-year historical average. What that tells an analyst is that the market has already fully priced in all the good news: the GNU, the gray list removal, the cloud migration. The valuation is priced for perfection, which leaves absolutely zero margin of safety for the investor if inflation spikes or an African currency collapses tomorrow.
It's a classic case of a great company, but perhaps not a great price at this exact second.
Exactly.
So we've covered the digital network infrastructure with MTN, we've explored the behavioral finance algorithms with Discovery, the banking defenses of Old Mutual, and the massive macroeconomic trade financing with Standard Bank. Now, I want to transition to the physical reality of the consumer.
That's it.
Let's talk about the physical goods themselves. Because with changing demographics, severely squeezed consumer wallets, and intense, relentless competition from international players, how are the companies that actually feed and clothe the African consumer adapting?
This is where economic theory hits the grocery store aisle. And we are going to look at a tale of two entirely different operational philosophies, targeting completely different ends of the consumer spectrum: Woolworths Holdings and Tiger Brands.
Let's start with Woolworths Holdings. And for our international listeners, it's important to clarify that this is a completely separate entity from the Woolworths in Australia, or the historical brand in the US or UK. South African Woolworths is a unique beast. The research notes describe their food division perfectly. They call it a supermarket with the soul of a deli.
That is exactly what it feels like to walk into one. They consciously chose not to play in the brutal, margin-crushing, mass-market price wars against competitors like ShopRite or Pick n Pay.
Right.
They operate in a heavily fortified premium niche. They target what in South Africa is called the high LSM demographic, the highest living standards measure. These are high-income, highly resilient consumers who are insulated from minor economic shocks. These shoppers demand organic produce, sustainable ethical sourcing, free-range meats, and above all, extreme convenience in the form of high-quality, ready-made meals.
And that premium strategy works incredibly well for them. Their return on capital employed, which is basically a measure of how much raw profit they squeeze out of every single dollar they reinvest back into the business in their food division, is consistently over 40%.
It's amazing.
That is an absolutely astronomical metric for a grocery retailer where margins are traditionally razor thin.
It's world-class.
Yeah.
And they achieve that 40% not just by marking up prices, but through intense, aggressive vertical integration.
Okay, how come?
They don't just want to sell the food, they want to control the entire process of making it. The major strategic move highlighted in the research is their recent outright acquisition of a company called Into Food Holdings. Into Food was already their largest independent supplier of prepared meals, fresh juices, and specialized produce.
So by buying them outright, Woolworths secures its most critical supply chain permanently, and they internalize the manufacturing profit margin that Into Food was previously making off them.
Exactly. It makes the food fortress even stronger. But here is the fantasy B2B play that the analysts are starting to model, and it's fascinating.
Oh, do tell.
Into Food doesn't just supply Woolworths in South Africa, they are a massive export operation. They fly fresh, premium convenience foods directly to global retailers, most notably Marks & Spencer in the United Kingdom.
Wait, so when someone in London buys a premium fresh fruit salad at M&S, there's a good chance Woolworths South Africa manufactured it.
Precisely. Woolworths isn't just securing local salads, they are quietly building a global B2B export platform.
That is brilliant.
Because the South African rand is relatively weak against the British pound, Woolworths can manufacture incredibly high-quality, labor-intensive premium foods in South Africa, export them, and generate massive margins in hard currency. They are transitioning from a local retailer into a global manufacturer of premium convenience foods.
That is the long-term structural bull case for their food business. But we cannot look at Woolworths without looking at the other half of their empire: fashion, beauty, and home. The food side is a fortified castle, but the fashion side looks incredibly vulnerable right now.
Vulnerable is almost an understatement. The structural threats facing local apparel retail are existential.
I have to ask about this dynamic because we see it globally, but it seems particularly brutal here. How does a premium local fashion retailer with physical stores and expensive local supply chains survive the absolute onslaught of the Chinese mega retailers?
Yeah.
I'm talking specifically about Shein and Temu.
It is the defining structural threat for the entire South African apparel industry. These platforms operate on a fundamentally different, almost frictionless economic model.
Right.
Woolworths has to design a winter coat 6 months in advance, manufacture it, ship it in bulk, store it in a massive warehouse, and then distribute it to hundreds of physical stores where it takes up expensive floor space. If it doesn't sell, they have to discount it heavily, crushing their margins.
Yeah.
Shen and Temu, utilizing advanced AI and hyper-agile Chinese manufacturing hubs, practically manufacture on demand. They bypass the physical store entirely, utilizing international postal loopholes to ship individual ultra-cheap garments directly to the consumer's door.
It's crazy.
The latest industry estimates suggest that Shan and Temu have already captured between 7 and 9 billion rand in local South African wallet share in just a few years.
That is a staggering amount of capital sucked directly out of the local retail ecosystem.
And it fundamentally resets consumer psychology. Once a consumer realizes they can buy 5 trendy dresses on Shein for the price of one basic dress at Woolworths, their expectation of value is permanently altered.
Yeah, you can't go back from that.
Woolworths is being forced into a corner where they have to heavily discount their fashion inventory just to clear the racks and stay relevant, which absolutely decimates the profitability of that division.
And there's another threat, competing for that exact same consumer wallet, and it's arguably much darker. The J.P. Morgan analysis on Woolworths highlighted a bizarre but very real sociological threat, the explosion of online gambling.
It is a fascinating and frankly grim data point.
The reports state that the South African online gambling and sports betting industry has absolutely exploded, surging to a 1.5 trillion rand market turnover. We're talking about apps offering live sports betting, virtual slots, casino games on your phone. Why is this specifically a threat to Woolworths fashion?
It comes down to the mechanics of discretionary income in a stressed economy. When inflation is high and wages are stagnant, people feel a profound sense of economic hopelessness.
Right.
The psychological appeal of a quick, massive payout via a gambling app becomes incredibly seductive. So that R1000 that a consumer might have historically spent on a new pair of premium jeans or a nice jacket at Woolworths is instead being siphoned directly into a sports betting app.
Oh, wow.
Online gambling is literally vacuuming up the exact pool of discretionary income that premium retail relies on to survive.
Wow. You are fighting hyper-efficient Chinese supply chains on one flank and the addictive psychology of a casino in your customer's pocket on the other. That is a brutal operating environment for the new CEO.
Which perfectly explains the extreme, almost unprecedented incentive structure the Woolworths board just implemented. They have essentially acknowledged how incredibly difficult this turnaround will be. They've dangled a massive 100 million rand special outperformance share award in front of their incoming CEO, Sam Ngumeni.
100 million rand, just as a bonus. What does he have to do to actually unlock that?
He has to perform a miracle. To vest those shares, he has to literally double the share price to R100 by the year 2031, while simultaneously maintaining a minimum of 15% annual earnings growth every single year.
That is insane.
The board isn't happening for incremental, single-digit operational tweaks. They are offering a fortune for a complete, sustained structural revaluation of the entire company.
Now, contrast Woolworth's premium, high LSM niche with our final giant, Tiger Brands. If Woolworth is the artisan deli, Tiger Brands is the absolute undisputed behemoth of the South African mass-market pantry. We are talking about iconic generational heritage brands, Jungle Oaks, Koo baked beans, all gold tomato sauce, Albany bread.
The scale is unmatched. Tiger Brands controls roughly 30% of the entire South African grocery basket. Think about that. Almost 1 in every 3 food items sitting in a South African kitchen cupboard was manufactured by this one company.
You would think that kind of market dominance guarantees massive profits, but looking at their history, they've had an absolutely brutal, miserable decade.
They have. They suffered from a classic case of corporate hubris and what analysts call the conglomerate discount. They became too big, too bloated, and lost focus.
Oh.
They mismanaged a disastrous international expansion into Nigeria that cost them billions. They made bad acquisitions in South America. And most devastatingly, they were at the center of the horrific 2017 listeriosis outbreak linked to their processed meat facility, which caused immense human tragedy and shattered consumer trust in the brand.
It looked like a permanent decline. But the recent research details a massive, ruthless self-help turnaround strategy under their newly appointed CEO, Jart Kruger.
And it really is a masterclass in getting back to absolute basics. Kruger came in and started aggressively cleaning house. First, they finally reached a settlement in the complex 7-year listeriosis class action lawsuit, removing that massive legal and financial overhang that had paralyzed the stock.
That's a huge relief.
Then, they systematically divested from distracting non-core foreign assets. They recently sold off their stake in the corrosive business in Chile. They stopped trying to conquer the world and decided to fiercely defend their home turf.
And they are taking the capital from those foreign sales and reinvesting it heavily back into their core domestic manufacturing. The absolute centerpiece of this turnaround strategy is a massive 1 billion rand super bakery project being built in Pretoria.
Right. And to understand why this matters, you have to understand the brutal economics of baking bread. Why spend 1 billion rand on a new bakery when your consumers are already struggling?
Let's break the math down.
Tiger Brands is attempting to become the absolute lowest cost producer in the country. Historically, they operated several older, geographically dispersed, highly inefficient bakeries. They had high maintenance costs, high energy waste, and high labor costs per loaf.
Right.
By shutting those down and consolidating the volume into one massive, highly automated, hyper-efficient mega facility, they drastically lower the marginal cost of producing a single loaf of bread.
Which they desperately need, because they're facing a terrifying reality regarding their pricing power. I looked at their recent trading update, and the numbers are stark. To achieve a meager 2% increase in the physical volume of goods sold, Tiger Brands actually had to swallow 1% in overall price deflation.
That is the crux of the mass market dilemma. The South African mass consumer is completely cash-strapped. Inflation has eaten their wages, interest rates have raised their debt repayments. They simply cannot afford to absorb another price increase on a can of baked beans or a loaf of bread.
Right.
If Tiger Brands raises the price of Albany bread by 2 rand, the consumer instantly trades down and buys the supermarket's cheaper, generic house brand bread instead.
Exactly. Private label or house brands now control a massive 25% of the total grocery market, and they are growing faster than the heritage brands. Tiger Brands realizes the era of automatically passing inflation onto the consumer to protect their margins is dead.
Completely dead.
They can't just raise prices anymore. They have to win on absolute volume and ruthless manufacturing efficiency. That super bakery isn't about making better bread. It's about making bread 2 cents cheaper than anyone else can, protecting their margin from the inside out.
It's a defensive posture, but a highly effective one if executed correctly.
But here is the fascinating conclusion. Despite all of these intense macro headwinds, despite a tapped-out consumer, deflationary pricing pressure, and the rise of private labels, iMaps, capital markets, actually rates Tiger Brands as an overweight, implying it will outperform the broader market. How do they justify a buy rating on a mass-market food producer in a struggling economy?
It comes down purely to the asymmetry of risk and reward embedded in the current valuation. Think about what we just discussed. The historical nightmares that dragged the stock down for a decade, the listeriosis lawsuit, the bad foreign investments, the bloated management, those are effectively gone.
Right.
They have been excised from the business. What is left is a company with a pristine balance sheet, practically zero debt, and it throws off a massive, highly reliable 5.5% dividend yield to investors.
You're getting paid handsomely just to hold the stock while they fix the business.
Precisely. And at a forward price-to-earnings ratio of just 13.7x, the stock is historically cheap. You are buying a cash-generating machine that provides the essential daily calories for tens of millions of people. You are buying it at a deep discount, right at the exact moment that their margin-expanding super bakery is coming online to boost profitability.
That makes a lot of sense.
The downside risk is heavily protected by the dividend and the cheap valuation, while the upside potential from operational efficiency is massive.
Okay, let's take a deep breath and try to synthesize this incredible journey we've just been on. We started by looking at this curated stack of giants on the Johannesburg Stock Exchange. And what we found across every single sector is that these are absolutely not static, sleepy legacy companies resting on their historical laurels.
Not at all.
They are undergoing radical, high-stakes, almost violent transformations just to survive and capture the next wave of growth.
Right.
We saw MTN literally morphing from a traditional telecom selling voice minutes into a massive fintech and infrastructure operating system for the entire continent.
Right.
Locking down cell towers and processing $500 billion in mobile money.
It's incredible.
We saw Discovery taking the historically adversarial insurance model and turning it into a global AI-driven behavioral data engine that actively engineers human health.
We watched Old Mutual, a 180-year-old institution, recognize its own vulnerability and aggressively take a massive multi-billion rand write-down just to build a digital bank and defend its legacy against nimble neobanks.
Right.
We saw Standard Bank executing one of the largest cloud migrations on the continent to secure its position as the undisputed sovereign toll booth for the massive China-Africa trade corridor.
And in the physical realm, we saw Woolworths vertically integrating its supply chain to become a global B2B food manufacturer while fighting off the dual threats of Chinese ultra-fast fashion and the psychological drain of online gambling.
And finally, Tiger Brands, engineering its way out of a lost decade to become the hyper-efficient, lowest-cost producer of essential calories for 60 million people.
It is a profound, undeniable testament to the extreme adaptability required to operate in the African market. You simply cannot survive here by standing still. The environment forces evolution at a pace that is often far more aggressive than what we see in traditional Western markets.
And as a quick reminder to you listening, this entire curated basket of phenomenal African growth discovery, Old Mutual, Standard Bank, Tiger Brands, Woolworths, and MTN, is entirely accessible to you. They are a core part of the iMaps capital markets universe.
That's right.
That means they're easily investable via interactive brokers, and they are fully eligible for iMaps actively managed certificates over on the EULAX in Stuttgart.
As we look back at all these massive structural transformations we've unpacked today, I want to leave you with a final, slightly provocative thought to ponder. We've talked extensively about these giants building incredibly sticky, enclosed digital ecosystems.
Right. From Discovery's Vitality Rewards algorithm capturing and monetizing your granular health data, to MTN's Momo platform holding your entire financial life in a mobile wallet, to Woolworth's personalized loyalty programs tracking every calorie you buy.
Yeah, it's everywhere.
As these ecosystems become more advanced and more deeply integrated into daily life, we have to ask a fundamental question about the future of the market. Will the African consumer ultimately reap the utopian benefits of this hyper-convenience and seamlessly integrated service? Or, a decade from now, will they wake up and find themselves locked inside heavily fortified, monopolistic digital silos where the switching costs, the penalty for leaving the ecosystem, are simply too high to ever escape?
That is the multi-billion-dollar question. And it goes right back to what we established at the very beginning of this deep dive. You do not need to look at Silicon Valley to see the bleeding edge of the future. The ultimate battle for digital locking, the real frontier of human behavioral economics and corporate survival is happening right now, in real time, on the JSE. Thank you so much for joining us on this incredible deep dive. We'll catch you next time.